Hi, Gary Klavan and Kevin Coyle here from Chicago. Now, we've got the second quarter update for you. And, we had this GDP in the first quarter. It was negative up until recently. They readjusted and said it was positive, 0.6%. And the second quarter came in at 2.3%. And, lo and behold, everybody thinks the rest of the year is going to be about 3%. And you put it all together and you get 2.1% growth, which has been exactly what it's been for the last 5 years. So it's the same sluggish growth. This year, the S&P's kind of reacting to it. It's not doing a lot. It's been very sluggish itself. So what's going on here?
Well, world economic growth is still largely tepid as well. You've got maybe 1.5% growth internationally. A lot of that has to do with stemming from 2007 is still the excesses of debt that's in the system. There's still people that are very, very cautious. We talked about last time how corporations have a lot of cash on their balance sheets and they're not making long-term investments and long-term employment hires. And I think the overall market environment, not only just economically, but just on a micro level, has maintained this cautious level stance since 2007.
Right.
But you also had what's going on earlier this year. You had a nice start to the year, but you've had the hints that rates are going to go up. So people have been kind of waiting to see what shoe drops there, because it's been 6-7 years since we've had the prospect of rising rates, and people forget what that might do to the stock market or what have you, even though it could very well be positive in the short run. But you also had the Greece issue, and you've had some significant issues going on in China in terms of their stock market going up almost 50% year to date and declining significally since then. So it's causing a lot of people kind of stay the course, if you will.
Right. Yeah, and talking about the Fed we were told a couple of years ago by the Fed that once unemployment got to 5.5%, they'd start raising rates. We're at 5.3 right now. It's interesting. I was at my health club the other day, and a gentleman there teaches a course at a community college. It's a 1-year certification on running these new kind of machines at distribution centers like Amazon. And the day after they all graduated and got the certificate, they got hired. All of them got hired. And that's because there's 5 million open, unfilled jobs. I mean, so certainly the job market is really strong. We really don't know what the Fed's going to do. And, it comes back to that same old core issue of diversification, because we don't know what's going on, and that's the place to be, although it hasn't worked as well recently.
Well, I mean, your traditional diversification entails bonds, stocks, cash, and you take it to the next level. You've got commodities, you've got foreign stocks, foreign bonds, MLPs, things of that nature. Well, you have interest rates at all-time lows, so bonds haven't been adding a diversification element. You've had commodities and energy down, so that's been bringing that component down. The international complex looked pretty good earlier in the year. It was adding nice diversification, but it's emerging markets affected by China. So you've kind of had this level in the water. Do you want to abandon diversification just when you might need it? Probably not. The one element that maybe hurt last year is that small caps and growth stocks were down. S&P was up, but so far this year, that's the best performing asset class. So that's one small sign where you're nice that you do have that level of diversification in your overall portfolio.
So we want to stick with diversification here for the time being, because it is the thing that will ultimately win out over the long term, especially in this muddled up situation going on.
Yeah, one time's a doubt too. If you add more to your reserves and you have a little bit less in the market, you got to go with what your gut tells you. But ultimately, 5 years from now, do you think the world gross domestic GDP is going to be higher than it is today?
Sure.
Is the stock market going to have a 20% correction sometime in the next 5 years? Yeah, it's
probably.
going to. So as long as you can stay the course and not have to be selling at opportune times,
it should be fine. Right. Good to go. So maybe we'll have more clearer news the next time we get in the third quarter report, and maybe we'll have a little more from the government on raising interest rates, although I'm not going to hold my breath on that one.
No.
So have a great summer.